Today I'll take you through how you should be thinking about in terms of strategies and how a strategy is formed and what goes into creating a strategy from a quantitative perspective. So as my pick shows, yes, I like try to give you some kind of paradigm. Maybe it is shift for few or maybe it not, but yes, I'll try to give you the perspective of how any strategy works and how the strategy should be analyzed when we are looking at from the quantitative perspective. So let's begin. So to begin with, I like to present you some hard truth. So I thought, let me give you first the shockers when we start with our presentation, that what you are going to enter into is some place where it requires hard work, real hard work, and you might get a tip here and there that, okay, you can go and buy XYZ stock because something is happening, but that kind of profits are not really consistent. You really need to do some hard work, and for the consistent work, you need to have good methodology, and through quantitative trading strategies, we try to establish some of the proven methods which can give you consistent profit. So that's our idea. So you can ask me, okay, you are talking about the trading strategy formulation. So what all you require? I say we require few steps. These few steps go about in any kind of a strategy formulation. Basically, we are talking about in the quantitative trading strategies out here. So we take you through the various process. The first starts with the hypothesis formulation. What is a hypothesis? You form a hypothesis that, okay, the market behaves in particular fashion. I like to do something like, I like to do a trend following or something like that, which we will be discussing in a short while. Then we have something like call. Once you have decided upon your hypothesis, you try and formulate all those codes in, say, in any testing softwares like R or Excel, through which you can check whether your hypothesis have really worked well in the past, and you try to optimize the parameters to see which parameter worked well in the history and which is you think can perform better in future going forward. So we calculate the backtesting and optimization. The third process goes into coding the strategy into the trading platform, where you have your hypothesis being backtested, proven, then you have your algos, you write your code such that you try to execute it through the trading platform, and you try to arrive at a better execution using any algo trading platform. So once that is done, you move on to the simulator testing. A simulator testing is a process where you try and send order not to the exchange but to the simulator environment, which will be looking like an exchange, but your orders will not get actually executed at exchange, but there will be a dummy kind of a exchange, and which will help you to test the functionality of your algo system. Once you have done the testing of your algo trading system, your functionality, then we move towards something called the trading in live market, and there you go. You have the full market and the full scenario for you to just go and take on the market. That is the 5-stage process that we normally go. In today's webinar, what I'll try to give you the idea about the hypothesis formulation, what kind of hypothesis formulation you can do, and then we spend considerable time on the backtesting and how, when you have a backtested result, how would you like to have a comprehensive view about the feasibility of the strategy. So that's how we're going to proceed for today's lecture. Okay, coming back to the first point, that is hypothesis, designing a trading strategy. As I always believe that market has place for everyone. It is up to us to choose a game. So choose your game, what game you would like to play. So the question can come to you, okay, I would like to play a trend following. So you might have heard various traders who have worked across industry, across geographies, across asset classes, who have made good amount of money in the trend following. So you can also choose that, yes, I would like to have some system which will be a trend following system, and whenever the market trends, I like to deploy that system, and your system will make money. So you follow a trend following system. A trend following system could be very well like something based on the moving averages. If I talk about the technical, So, or it would be something like based upon the say crossover of the moving averages, or you might have some other technical indicators like you try to find out some kind of a trend in the market and then you play with it. Then this is and then trend following give you certain amount of risk and the rewards are higher. Arbitraging, you can choose to do an arbitraging, and arbitraging would be nothing but you try to find out what is the difference between the prices of a same security being traded at say two different exchanges. It might be traded at two different geographies, something like a stock being traded in US and Europe. You try to see, oh my god, there's a difference in the prices, let me go and harness it. So you can also have some kind of arbitraging method in say, oh, I see the options in Nifty are not very well priced compared to the other options in Nifty, or say vis-a-vis future. Then you try and trade such way that you really get the difference between out, and these kind of strategies are usually termed as low risk and low return because you do not have these arbitrages are pure arbitrages, and these ones says that okay, they will come back, you will not lose money. It's just that there is a temporal mispricing in a same instrument in a two different exchange, or a two instrument of a same underlying because of the market trading, and here the algorithmic trading plays a very crucial role. Moving on, we have, or you can choose a third type of strategy that we call mean reversion. A mean reversion would be something like statistical arbitrage that we call a pair trade. So you look at say the pair trade between Infosys and TCS based on tools like we talk about tools like co-integration, which gives you idea okay that these two pairs are co-integrated, they do have a tendency to revert back. So if Infosys moves quite away from the TCS, then probably you can have a statistical evidences where you can go and trade and make money out of these two stocks. You go long on Infi or you go short on TCS, and vis-a-vis you create a strategy. Third is a market making strategy. Let me give you some idea about what's a market making strategy. A market making strategy is nothing but a condition where a trader tries to be on the bid and the ask side of the market. Suppose I am trading in the Nifty futures. So a market maker would have the idea of trying to stand at bid and ask, say B dash and A dash, so that he would be like that someone would come and sell him at A dash and he get bought at B dash. So what will happen is I am able to sell at A dash and being bought at B dash, my net position is 0, but I would have pocketed in the difference in pocket. So this is something where I always try and keep standing on the bid and ask side such that the difference I do get pocketed, and my idea would always be that A dash minus B dash is always greater than my transaction cost, so that I really make some profits. So that is the idea of a market maker who would like to stand in the market at various points and try to make the difference. The other market maker would be someone who is being designated by the exchange, and the designated market maker would be having the obligations where he would be required to manage a particular spread. So he would have A dash minus B dash is equal to say S, which is being obligated by him by the exchange for the return of some kind of incentive. So that's how any market maker works, and that is how a market making strategy is. So it's usually not being done, it is being done from the basic use of your HFT, where you look at the data which is coming to you with at very high frequency, and you keep on analyzing it, and you keep placing your bid and ask such that in always condition your position is close to 0 and you really make money out of it. So these could be some broad categorization and thought where you can look for these strategy, your strategy, whatever kind of strategy you might look at, okay, an option strategy, an option would fall somewhere like and arbitraging, where you see that okay, there's a difference in the option price, I'll do it. Or you take naked options, then you can say, oh, it's more of a trend following strategy and something like that. So these are the broad categorization I thought that I should lay before you, and the various kind of strategies can be put under these various broad categorizations. Okay, so now you can formulate your hypothesis in one of these areas. Says that a stop loss is a point where you feel like, oh, I cannot lose more than X amount of money in the particular strategy, so I should take a stop loss. Well, we do not look a stop loss in this fashion. For us, a stop loss is a condition where your hypothesis have failed. So once your hypothesis has failed, but your trading signal has not generated a signal to cut your position, then we say it is better to take a stop loss because hypothesis have failed and you should get out of your position even if your trading signal in opposite direction has not been generated. So that is how we define the stop loss. When we go into the EPAT course, we discuss about various stop loss conditions in a trending series or in a mean reverting series, where we can show you that a hypothesis have failed, still the trading signals will appear that it should be buy or it should be sell. So, but it is very wise to cut out your position and it gives you a tremendous amount of boost in your profits. So that's how we believe in designing the stop loss, not just based upon the amount of money you can lose, but it also a function of your hypothesis. And that's why it plays a very important role. I always stress on the how you define your hypothesis, and that's a long time being spent in a EPAT course while we discuss about the hypothesis formulation. Okay, now profit taking. Now you have to look at profit taking similarly as we said that stop loss, that my hypothesis is valid. Now I don't see much of the movement from that place. Says hypothesis says that beyond this point there won't be much movement, so you cut your positions. So you have to define your stop losses and profit taking again from the perspective of your hypothesis. Sufficient sample trades. Yeah, I have seen many people when I have been interacting with lots of traders, and I have found out that they'll come to me and say, okay, I have done the back testing and see these are the results of 20, 30, 40 trades, and they say that, oh, my system seems to work well now. Should I go ahead and trade, test in the market? I always say strictly no. I need at least 100 plus trades to see whether your system is right or not. At least you need to have other criteria also, which I will discuss, but at least in terms of simple number, I need at least 100 trades. That gives me some confidence. And finally, statistics helps to formulate your hypothesis. So you can ask me, oh, you have shown me trend following, arbitraging, mean reversion. Okay, so much. What is the basic tool to do that? So my basic tool is statistics. The statistics gives you how the market looks like. It can give you the idea about, oh, this thing looks like this, so I should try this. So let's move ahead now. Okay, now the hypothesis is formed. So what? So once your hypothesis is formed, you need to check the past performance for the design hypothesis. You say market is going to trend, fine, it's going to trend and I am going to buy at this position, but fine, why should I agree upon your point? So you need to show me some kind of results. Result performance stats should back your hypothesis. You should say, okay, these times my hypothesis will work and these will be the returns. We'll take up a sample example regarding this and then you will be able to more appreciate on these points. And why you need it. Investor needs to be shown numbers to validate the substance in the analysis. I'm an investor. I will say, okay, I agree that it's good that you feel that market will trend or the market will mean revert, or you can be a good market maker. But what makes me believe in your numbers? So you say that, okay, these is the numbers which have been done in this fashion. You will be subjected to through the scientific rigor. You can do whatever and you can see that yes, the results are fine, and these past performance will give you some kind of an idea about how the strategy is going to perform in the future. And that's how you should approach things. Hence, backtesting is important. Backtesting is a process by which a trader subjects the market to the designed rules to check the performance in the past. Process in backtesting. You choose a detailed historical data with the following characteristics. Sufficient data number of data points so as to create sufficient sample of trades. At least 100 plus trades have to be generated to see whether yes, my hypothesis hold true, and at least it gives you some confidence about your trading system. Should be in sufficient details with the various market scenario being handled. Some scenarios like bullish, bearish. So what are these? Let me give you an idea about the various market scenario. A market scenario, a market can look like this. Okay. So here we will have, say, I call it this phase as a consolidation, then bullish, then distribution. I'll just explain to you what is happening in each of one of them. Bearish and consolidation again. So let's start from here. What happens that there is some kind of new inventions, new technologies, or new kind of policies which affect some kind of a bullishness in the market. You can look at new inventions, something like your IT boom. When IT came, the internet and so many websites came, so market took up a bullish move and just started keeping moving up. Or it could be a policy action like from 2000 to 2004, many FIIs started investing in India. They find it out to be a very lucrative, and the money bringing in India became very easy. So many FIIs started moving into India. So we have a bullish phase where because of some kind of policy change, you have a market moving up. But once the market have moved up, it has to come into some kind of stabilizing factor. So what happens, the stabilization factor is that money starts moving from the sectors, the stocks which have really performed well, and that then start moving into the stocks which have not really performed well. So this is the way the money starts churning. Not new money does not come into the picture. Money flows slightly less, and you will have some kind of a tapering. You might not have this just a flat plateau. You might also have something like this kind of a phase. Then after the distribution, the euphoria has just subsided and people start feeling, oh my god, I am just paying too much for this amount of stock, so let me go and short. So during that point you attain a bearish kind of phase. Again, with being triggered by some kind of a policy or some kind of a feeling that okay, that this is not going to sustain, and people just start cashing it out. And when people start cashing it out without any buyers, you have sudden fall. That is we call bearish. And then after the market have gone down, you find that there are few takers who are always on the sidelines who say that okay, now the prices have corrected to a certain level, let me come into the market and start buying. So that is a phase where you start have some buying, the consolidation. So you have basically three phases that do come into the market: bullish, distribution, bearish, and consolidation. So what you really get out of it is a different scenarios. Now, for me to say that this is very easy after in hindsight, that movement is bearish, this movement is bearish, bullish, and consolidation. Then, but if I have to look all these things in terms of how will they in future, it's very difficult. But when you are deciding upon your data points in terms of choosing out, so you should have a phase where is a bullish phase in the market, distributive phase in the market, bearish and consolidative phase, to really take the full gamut of the market picture. Make sure the provision for the brokerage and slippage cost has been made into your system while you are trying to do the back testing. And last, beware of overfitting. What people might do is they say that okay, let me try out some kind of juggling. A juggling could be something like we will be taking an example of say moving average. So you say that okay, 10 moving average is not working well, let me try out with 12, 13, 14. Oh, 14th moving average is working very well. Let me use it because the results for the past say 10 years have been wonderful. So let me use it, and I hope this will work well. So that is a case of overfitting. You should be very beware of that your system does not overfit the data. How you remove it? I'll just give you an example. Say, suppose a trading strategy deploys end-day moving average for the signal generation. Now the question trader faces, what should be the value of n? As I was just talking about, say let's take a sample hypothesis which we will be using in the later half of this lecture, is that if my market or my daily prices closes over say n days moving average, then I will buy, and if my market price close below n day moving average, then I will sell. A very simple hypothesis. I do not know how it works, how it do not work. I'm just taking, maybe this is give me some kind of idea of the trend.